What are financial liabilities? Financial liabilities are contractual obligations to deliver cash or another financial asset to another party. According to International Financial Reporting Standards 9 or IFRS 9, financial liabilities are classified as either measured at amortized cost or measured at fair value through profit or loss. Financial liabilities that are measured at amortized cost are initially recognized at fair value, which is typically the transaction price and is generally adjusted for any transaction costs incurred by the entity when issuing the liability. Transaction costs may include legal fees, accounting fees, underwriting fees, and other direct costs that are directly attributable to the issuance of the liability. These costs are typically subtracted from the fair value of the financial liability to arrive at the initial carrying amount of the liability. Subsequently, they are measured at amortized cost using the effective interest method. Examples of these liabilities include loans, trade payables, and bonds. On the other hand, financial liabilities measured at FBTPL are recognized initially and subsequently at fair values, with subsequent changes in fair values recognized generally in profit or loss or in the income statement of the entity. Examples of financial liabilities at FBTPL include held for trading liabilities such as derivative financial liabilities and certain liabilities that are designated by the entity at fair value through profit or loss. Now, under IFRS 9, remember that financial liabilities at FBTPL are measured at fair value with changes in fair value recognized in P&L. So this is especially true for financial liabilities that are held for trading. However, for financial liabilities designated at FBTPL, changes in fair value that are attributable to the entity's own credit risk, IFRS 9 provides an accounting policy choice to recognize these changes in other comprehensive income or OCI instead of P&L. Now, the reason for this accounting policy choice is to avoid presenting gains or losses that result from changes in the entity's own credit risk in profit or loss, as these gains or losses are not necessarily indicative of the entity's performance. To illustrate, let's say that the entity's credit risk worsened during the period, and the creditors, as a result, increased the interest rate imposed to the entity. Now, this increase in interest rate will result in lower present value of future cash flows and therefore decrease in the fair value of the liability. A decrease in the liability will therefore lead in a gain in profit or loss, which is counterintuitive, since it's as if you are rewarding the entity because its credit risk worsened. So that is why recognizing these changes in OCI allows for a more comprehensive presentation of the entity's financial performance and financial position. Now, when there is a change in fair value of a financial liability designated at FBTPL that is attributable to changes in the entity's own credit risk, the entity must first separate the fair value changes that are attributable to the changes in its own credit risk from the fair value changes that are attributable to other factors. The portion of the fair value changes that are attributable to changes in the entity's own credit risk is recognized in OCI, while the remaining portion, such as those attributable to interest rate risk and other price risk, are recognized in profit or loss. The exception to this is that if recognition of these changes in fair value in OCI would create or enlarge an accounting mismatch in profit or loss, then the entire changes in fair value will be recognized in profit or loss instead. It is important to note, however, that once recognized in other comprehensive income, gains or losses attributable to changes in the entity's own credit risk cannot subsequently be reclassified to profit or loss, even upon the recognition of the financial liability.